Hey everyone, welcome back to Corporate Decoder, the place where we crack open corporate secrets and see if they're really as fancy as they sound or just a bunch of hot air. Today we're diving into Dynatrace Incorporated's latest filing, and let's just say they're talking about money, specifically their financial party for the quarter that just ended. So what is the big news? Dynatrace is sharing their financial updates for the quarter ending the 30th of September, and they're not just telling us, they're also holding a big conference call to chew the fat about it. This is where the juicy bits usually hide. The actual numbers that tell us if they're rowing with the current or fighting against a tsunami. Now, the really important stuff is usually tucked away in these exhibits. They've attached a press release that spills the beans on their financial results and another document that talks about their total annual recurring revenue expansion trends. This is where we'll find the good stuff, the numbers that can make or break a company's reputation. Let's talk about what is actually being traded here. Dynatrace has common stock, and you can find it traded on the New York Stock Exchange under the ticker symbol DT. This is essentially the heartbeat of the company, what investors around the world are buying and selling. Alright, let's get into the meat of it. This investor presentation gives us a peek into their total annual recurring revenue, or ARR expansion trends. Think of ARR as the money a company expects to get from subscriptions over a year. When they talk about expansion trends, it means they're not just keeping their current customers, but they're actually getting more money from them. This is a fantastic sign. It means their customers are finding more value in what Dynatrace offers, perhaps buying more services or upgrading their plans. In simpler terms, they're not just holding onto their pie, they're making the pie bigger by getting their customers to buy bigger slices. This is what Warren Buffett would call a sign of a strong, sticky product. It shows customer loyalty and a growing business. Now, let's see what the actual numbers are doing. While this filing doesn't have the full financial tables directly embedded in a way we can easily read here. The fact that they're highlighting their ARR expansion trends in a presentation and mentioning financial results is a strong indicator. Usually when companies are excited about their ARR expansion, it means their revenue is growing faster than just acquiring new customers. It is also about getting more from the customers they already have. This is a much more sustainable and profitable way to grow. If they're seeing significant expansion, it suggests their product or service is becoming more indispensable to their clients. This also means their sales teams are doing a great job of upselling and cross-selling, which is a sign of a mature and effective sales operation. What does this mean for Dynatrace? Well, it suggests they are likely experiencing strong revenue growth. In the world of software and cloud services, Arkansas R is king. A high ARR expansion rate means they're likely gaining market share and becoming a more dominant player. From an investor's perspective, this is exactly the kind of growth metric you want to see. It's a signal that the company has a product that customers love and are willing to spend more on over time. This also often translates to higher profit margins because it costs less to sell more to an existing customer than to acquire a brand new one. However, we also need to be cautious. While ARR expansion is great, we always want to see the full picture. What are their costs like? Are they still spending a lot to get this expansion? What about their overall profitability? This report focuses on the positive trend of ARR expansion, and that is good. But a complete financial deep dive would require looking at their income statement and balance sheet to ensure they are growing profitably. We also need to consider the broader economic environment. Are customers cutting back on spending? If Dynatrace is still growing its ARR strongly, despite economic headwinds, that is an even bigger testament to their product's value. One of the key risks for any company in this space, and Dynatrace is no exception, is competition. The market for software intelligence and observability is crowded, with many players vying for customer attention. If Dynatrace is successfully expanding its ARR, it implies they are fending off competitors and proving their superior value. We also want to consider if they are diversifying their revenue streams or if they are overly reliant on a few large customers. A strong ARR expansion from a broad customer base would be a very positive sign. So what is my take on Dynatrace based on what we're seeing here? They appear to be on a strong growth trajectory, with a clear focus on maximizing value from their existing customer base. This is a smart strategy, as it's often more efficient than solely relying on new customer acquisition. Their focus on ARR expansion suggests a product that is not only sticky, but also capable of evolving to meet customer needs as they grow. The main opportunity for Dynatrace lies in continuing this trend, potentially expanding into new markets or offering new services that further deepen customer relationships. The primary risk is maintaining that growth rate in an increasingly competitive landscape and ensuring that this expansion translates into sustainable, long-term profitability. Alright, that is our breakdown of Dynatrace Incorporated's latest filing information. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.